Imagine waking up one morning to discover that the savings under your mattress are now illegal. Not counterfeit, not stolen, just illegal to own. An executive order has declared that what you thought was yours, what you saved, what you earned, what you held as security is now a crime to possess. You're given a deadline. Turn it in or face 10 years in prison. This isn't a dystopian novel. This isn't a dictatorship in some far-off land. This happened in the United States of America. In 1933, the federal government issued Executive Order 61002, making it illegal for American citizens to own monetary gold. Families who had saved gold coins for generations were told to surrender them within weeks. Banks were instructed to report anyone who refused. And those who tried to hide their wealth faced not just fines, but imprisonment. But here's what many historians find most troubling about this episode. After the government collected the gold at 20.67 per ounce, it revalued it at $35 less than a year later. Overnight, the wealth ordinary Americans surrendered became 70% more valuable in government hands. This is the story of Executive Order 6102, the day America made gold ownership a federal crime. And if you think such measures belong only to history, you might want to pay closer attention, because some analysts argue that the patterns established in 1933 haven't disappeared. They've simply evolved. The tools have changed. The language has adapted. But the underlying mechanism they suggest remains intact. When governments face fiscal pressure they cannot manage through conventional means, extraordinary measures sometimes follow, and they're rarely announced as confiscation. To understand how a democratic government could legally strip its citizens of a fundamental form of property, we need to step back to the world before 1933. For most of human history, gold served as money, not paper promises, not digital entries. Gold tangible, heavy, indestructible. Empires rose and fell, but gold remained a constant store of value. In the United States, this relationship was formalized through the gold standard. Since the late 1800s, every dollar in circulation was theoretically backed by gold held in government vaults. In principle, you could walk into a bank and exchange paper bills for actual gold coins. That convertibility was the foundation of monetary trust. It created discipline. Governments couldn't simply print money endlessly because every new dollar theoretically required gold reserves to support it. The supply was finite, the constraint was real, but then came the Great Depression. The stock market crashed in 1929, banks failed by the thousands, and unemployment soared past 25%. By early 1933, the newly inaugurated President Franklin Delano Roosevelt confronted a collapsing economy and a terrified public. People were pulling money out of banks, not just paper currency but gold. Trust in the financial system had evaporated, and when trust disappears, so does the currency. Roosevelt and his economic advisors believed the only path to recovery required devaluing the dollar, making it worth less relative to gold, so that prices might rise and debts might become easier to service. But there was a structural problem. As long as citizens could freely convert their dollars into gold, they would do exactly that, draining reserves and making devaluation impossible. Some economists at the time argued that the gold had to be centralized. It had to be removed from private hands and placed entirely under government control. And so on April 5, 1933, the president signed Executive Order 6102. With a stroke of a pen, private ownership of monetary gold became a federal crime. April 5, 1933, Washington, D.C. The nation is barely 2 months into Roosevelt's first term, and the atmosphere is one of controlled crisis. Banks are closed under a declared national holiday, ostensibly to prevent runs. In reality, many historians suggest the government is buying time to restructure the monetary system. Behind closed doors, Treasury officials and legal advisors draft an executive order unlike anything the country has seen in peacetime. It will not be debated in Congress. It will not be put to a public vote. It will simply be announced. The order itself is brief, just a few pages, but its reach is comprehensive. All persons are required to deliver all gold coin, gold bullion, and gold certificates to a Federal Reserve Bank or authorized agency by May 1st. The compensation, $20.67 per ounce. The official government price. Exemptions are narrow. Jewelers, dentists, and individuals holding up to $100 in gold coins, roughly 5 coins, are permitted to keep their holdings. Everyone else must comply. Failure to surrender gold is punishable by a fine of up to $10,000 equivalent to over $200,000 in today's dollars, or 10 years in federal prison, or both. Banks are required to report any suspicious withdrawals or gold storage activity. The enforcement mechanism is immediate and thorough. The legal justification cited the Trading with the Enemy Act of 1917, a wartime statute that Roosevelt's administration interpreted broadly to cover a domestic economic emergency. Legal scholars at the time debated whether this was constitutional. Some argued it stretched executive power beyond its intended limits. Others maintained it was a necessary measure to prevent economic collapse. In a fireside chat weeks later, Roosevelt defended the policy. "We are on our way back," he told the nation. "More important than gold, more important than any currency, is the restoration of confidence." For him, the order was not confiscation, it was stabilization. What followed was not widespread resistance, but quiet compliance. Most Americans brought their gold coins, family heirlooms, emergency savings, security, to local banks and Federal Reserve branches. They received paper dollars in exchange, the same paper dollars that many suspected would soon be worth less. But the alternative was prison. The social pressure was immense, and the propaganda was relentless. Posters, radio broadcasts, and newspaper editorials framed surrender as patriotic duty. To refuse, they suggested, was to betray your country in its hour of need. By June 1933, the government had collected hundreds of millions of dollars worth of gold. The transfer was complete. Ordinary citizens no longer held the ultimate store of value. The government did. Here's how the mechanism functioned, and why some economic historians describe it as one of the most significant wealth transfers in 20th century America. The government set the redemption price at 20.67 per ounce when it collected the gold. That was the official rate under the existing gold standard. Citizens were told this was fair compensation because it matched the legal price. There was no negotiation, no market-based valuation, no option to hold out for better terms. You received 20.67, and that was final. But less than a year later, in January 1934, the Gold Reserve Act changed everything. The official price of gold was reset to $35 per ounce, a 69% increase. This wasn't market-driven inflation. This wasn't natural price discovery. This was a deliberate policy revaluation, and the gold that had just been surrendered by private citizens was now officially worth almost twice as much. Let's examine what this meant in practical terms. If you had turned in $1,000 worth of gold in 1933, roughly 48 ounces, you received $1,000 in paper currency. But under the new valuation, the government now priced that same gold at $1,690. The difference didn't return to you. It remained with the Treasury, which used the revaluation to expand the monetary base, issue more dollars, and fund New Deal programs. Your wealth didn't vanish into thin air. Some analysts argue it was effectively redistributed, quietly, legally, and without compensation. For the government, this represented a form of monetary expansion. By acquiring gold at one price and revaluing it at another, the Treasury could issue new currency without printing it from thin air. The gold backing legitimized the expansion. The new dollars entered circulation, prices began to rise, and debts became easier to service, exactly as the Roosevelt administration intended. Some economists argue this policy was necessary to escape the deflationary spiral of the Depression. By devaluing the dollar and increasing the money supply, Roosevelt's team may have helped restart economic activity. But the method, mandatory surrender followed by revaluation, remains controversial nearly a century later. Because even if the macroeconomic outcome benefited the nation as a whole, the mechanism established a precedent that private property, including money itself, could be seized when policymakers deemed it necessary for systemic stability. And precedents, once set, rarely disappear. They wait. The American gold order wasn't unique in financial history. Across the 20th and 21st centuries, governments facing severe fiscal pressure have repeatedly implemented measures that, according to critics, transferred private wealth to stabilize public systems. In August 1998, Russia faced a currency crisis. The ruble had been pegged to the dollar at a fixed rate, but this required enormous foreign exchange reserves to defend. As capital fled the country, Russia burned through billions trying to maintain the peg. The central bank's reserves dwindled from $24 billion to less than $12 billion in weeks. The mechanism was straightforward but brutal. The government could either default on its debt, allow the ruble to collapse, or both. On August 17, Moscow chose both. It announced a devaluation and a moratorium on debt payments. Overnight, the ruble lost more than half its value against the dollar. For Russians holding rubles, this meant their purchasing power was cut in half within days. Banks froze accounts to prevent total collapse. Ordinary Russians who had trusted the banking system watched their deposits lose up to 70% of their value. Finance Minister Sergei Kiriyenko later acknowledged the decision was the most difficult of my life, but insisted there was no alternative. The cost, however, was borne entirely by depositors, not by the policymakers who had created the unsustainable currency peg. Cyprus in 2013 provides another case study. The island nation's banks were severely overleveraged, holding far more liabilities than they could cover. Specifically, Cyprus banks had invested heavily in Greek government bonds, and when Greece restructured its debt in 2012, those bonds lost most of their value. The two largest banks, Bank of Cyprus and Laiki Bank, suddenly faced massive capital shortfalls. They were technically insolvent. The European Union and the International Monetary Fund offered a bailout, but with an unprecedented condition: depositors would have to participate in what officials called a bail-in. Here's how the mechanism worked. Instead of taxpayers across Europe funding the rescue, the money would come from those who had deposited funds in Cypriot banks. Accounts over $100,000 were subject to partial confiscation, a haircut in financial terminology. In the case of Laiki Bank, the largest depositors lost up to 47.5% of their holdings. The banks were closed for nearly 2 weeks while authorities implemented the plan. When they reopened, capital controls were in place, limits on withdrawals, restrictions on transfers. Jeroen Dijsselbloem, president of the Eurogroup at the time, suggested this model could become a template for future banking crises. The announcement sparked panic across southern Europe, as depositors in Spain, Italy, and Greece wondered if they might be next. Lebanon in 2019 offers perhaps the most recent parallel. The country's banking system collapsed under decades of corruption and mismanagement. Banks imposed severe capital controls, limiting withdrawals to a few $100s per month. People who had deposited their salaries for years found themselves effectively locked out of their own accounts. The Lebanese pound lost over 90% of its value. Former central bank governor Riyad Salameh, once celebrated as a financial wizard, is now under investigation in multiple countries. Ordinary Lebanese citizens, meanwhile, saw their life savings reduced to nearly nothing. In each case, the pattern follows a similar trajectory. A financial crisis creates systemic pressure. Governments or banking authorities face a choice: accept systemic failure, or implement emergency measures that shift losses onto private holders of wealth. And in each case, critics argue the burden fell heaviest on ordinary savers, rather than on the institutions or policymakers whose decisions contributed to the crisis. Fast forward to the 21st century, and the tools have evolved, but some analysts suggest the underlying logic persists. Modern governments don't need to confiscate gold directly. They have something far more sophisticated: control over the monetary system itself through central banking. In 2008, when the global financial system teetered on the edge of collapse, central banks didn't seize physical assets. They expanded the money supply. The Federal Reserve launched quantitative easing, purchasing trillions of dollars in bonds and mortgage-backed securities with newly created currency. The stated goal was to stabilize markets and prevent a second Great Depression, and by many measures, it succeeded. Stock markets recovered, major banks survived, the immediate crisis was contained. But here's what some economists point out happened to wealth distribution in the aftermath. Housing prices had already collapsed, wiping out what was, for many families, their primary store of wealth. Retirement accounts took years to recover their pre-crisis values. Meanwhile, the flood of new money disproportionately inflated asset prices: stocks, real estate, bonds. Those who owned these assets saw significant gains. Those who didn't saw their relative position decline. Think about your own financial situation right now. If you're saving to buy a home, you may have noticed that prices have surged far beyond what wage growth alone would justify. According to housing data, the median home price in the United States has more than doubled since 2000, while median household income has increased by less than 40% over the same period. Some analysts attribute this divergence directly to monetary policy that inflates asset values, while wage growth lags. This represents what some critics describe as a hidden tax: not announced, not voted on, but real nonetheless. Your salary might look larger on paper, but your ability to purchase a home, to save for retirement, to build long-term wealth, many argue it's harder now than it was for previous generations. During the COVID-19 pandemic, this pattern accelerated dramatically. Governments worldwide injected trillions into their economies. Stimulus checks were distributed and widely praised as necessary relief, but much of the newly created money, according to financial analyses, flowed directly into asset markets. Billionaires collectively added hundreds of billions to their net worth during the pandemic years. Meanwhile, grocery prices surged, rent increased sharply, gas, utilities, basic necessities, all became measurably more expensive. When people asked why, they were often told it was supply chain disruptions or temporary inflation. Some economists argue those were contributing factors, but that the deeper cause was monetary, creating money faster than the economy could produce corresponding value. Federal Reserve Chairman Jerome Powell acknowledged in 2022 that we now understand better how little we understand about inflation. The admission came after inflation had already eroded purchasing power significantly. Some analysts suggest this represents a modern version of the 1933 mechanism: not confiscation through legal order, but dilution through monetary expansion. The outcome, they argue, is similar. Wealth flows from those holding currency to those holding assets, and the transfer happens quietly, without explicit announcement. History isn't only about looking backward. Pattern recognition matters most when applied to the present and near future. And right now, in 2025, some analysts observe echoes of 1933 in how governments are approaching cryptocurrency and decentralized finance. In recent years, regulatory scrutiny of digital assets has intensified significantly. In the United States, the Securities and Exchange Commission under Chair Gary Gensler has taken an aggressive enforcement approach, arguing that most cryptocurrencies qualify as securities and therefore fall under SEC jurisdiction. Proposed legislation, such as the Digital Asset Anti-Money Laundering Act, would require exchanges to report all transactions above certain thresholds, grant authorities power to freeze accounts deemed suspicious, and in some jurisdictions, allow seizure of crypto holdings without warrants in cases involving national security or serious tax evasion. In 2024, the European Union implemented the Markets in Crypto Assets Regulation (MiCA), championed by the European Commission and supported by European Central Bank President Christine Lagarde. The framework requires all crypto transactions meeting specific criteria to be registered with central authorities. Privacy-focused cryptocurrencies, designed to obscure transaction details, face severe restrictions or outright bans in several jurisdictions. Proponents, including officials from the Financial Stability Board and national finance ministries, argue these measures are essential to combat money laundering and terrorism financing. Critics, however, including privacy advocates and some blockchain developers, suggest they establish infrastructure for broader financial control. Some commentators have raised a provocative question: could a government facing severe fiscal crisis issue an order similar to Executive Order 6102, but targeting Bitcoin or other digital assets instead of gold? The mechanisms arguably already exist. Digital wallets can be traced through blockchain analysis. Exchanges can be legally compelled to freeze accounts. And unlike physical gold, which can be buried or hidden, cryptocurrency assets exist on distributed ledgers, permanent, largely transparent records. University of Texas economist John Cochran wrote in 2023, "The interesting question is not whether governments can control cryptocurrency, it's whether they will choose to exercise that control, and under what circumstances." His point being that capability exists. What remains uncertain is political will and triggering conditions. This isn't to suggest such a scenario is imminent or even probable, but some observers note the precedent is clear. When governments have believed that private ownership of an asset poses systemic risk, extraordinary measures have historically followed, not with apologies, not always with compensation, but with legal authority and enforcement mechanisms. While debates over cryptocurrency continue, another shift is occurring with less controversy: the gradual elimination of physical cash from everyday commerce. Across Scandinavia, many retailers no longer accept paper money. In China, mobile payment systems have become so dominant that carrying cash is increasingly impractical. Even in the United States, contactless payments, digital wallets, and banking apps are rapidly displacing coins and bills. On the surface, this transition appears to be pure convenience, and in many respects it is. Digital payments are faster, more efficient, and create detailed records that can simplify accounting and tax compliance. But some privacy advocates have raised concerns about what they see as a darker implication. When all money becomes digital, all transactions become traceable, and when all transactions are traceable, they argue, the potential for control increases significantly. Imagine a financial system where every purchase you make is visible to your bank, your government, and potentially third-party data aggregators. They know what you buy, where you spend, which causes you support. If you fall behind on tax obligations, your account could theoretically be restricted remotely. If you donate to a political organization the government deems problematic, your financial access might be limited. No judge, no hearing, just algorithmic enforcement of policy. This isn't entirely hypothetical. In February 2022, during protests in Canada, the government invoked the Emergencies Act to freeze bank accounts of individuals associated with the trucker convoy, not because they had been convicted of crimes, but because they were suspected of supporting what authorities deemed an unlawful assembly. Some had simply donated small amounts to a crowdfunding campaign. Yet their accounts were frozen, their credit cards stopped functioning, and their ability to transact was suspended without trial or judicial oversight. Canadian Deputy Prime Minister Chrystia Freeland defended the action. "We are making these changes because we know that these platforms are being used to support illegal blockades." Civil liberties groups, however, expressed alarm at what they called a dangerous precedent for financial control without due process. Think about what this might mean in your own life. If every dollar you own exists only as a number in a database controlled by institutions that answer to government authority, you don't fully own your money. You have access to it, subject to conditions that may change, and the decision of when that access ends may not ultimately be yours. Proponents of digital currency argue that it's more secure, less prone to physical theft, and easier to recover if lost. And for many use cases, that's demonstrably true. But some critics point out the trade-off. Physical cash offers anonymity. Digital money by design does not. And once anonymity is eliminated, they argue, a fundamental layer of financial autonomy disappears with it. So why does this pattern appear repeatedly across centuries, across different nations, across varying systems of government? Why do democracies and autocracies alike eventually reach for similar tools when facing fiscal pressure? This is why the 1933 gold order remains instructive nearly a century later. It wasn't a conspiracy. It was policy announced publicly, defended legally, implemented through established institutions, and yet many analysts note it transferred billions of dollars in wealth from private citizens to government coffers, without consent and without market rate compensation. The specific tools have evolved, the language has been refined, but some observers argue the underlying dynamic persists. When systemic stability is threatened, private property rights may become negotiable, not openly, not with announcement, but through emergency measures, executive orders, or regulatory changes that accumulate gradually until the transformation is complete. So what should we take from this history? The lesson isn't that all government policy represents confiscation, or that every economic intervention is illegitimate. The lesson is structural. The modern financial system built on fiat currency, fractional reserve banking, and centralized monetary control creates conditions where during crises, extraordinary measures become politically feasible. You might believe your savings are secure because they're in an FDIC-insured bank, but insurance only functions if the system itself remains stable. If systemic stress exceeds the capacity of insurance funds, which are themselves just another layer of government promise, the insurance becomes a guarantee written on paper that may prove insufficient. Argentina, Russia, Cyprus, Lebanon, each had deposit insurance schemes. When crises arrived, insurance either proved inadequate, was overridden, or was rendered meaningless by currency collapse. So what might one do with this awareness? The answer isn't paranoia or withdrawal from the financial system entirely. It's informed positioning, understanding that history doesn't repeat precisely, but that patterns echo across time. Understanding that tools used in 1933, emergency powers, executive orders, asset restrictions, still exist in modern legal frameworks, just under different names. Understanding that future equivalents of gold confiscation might not look like soldiers at your door, but like frozen accounts, devalued currency, or regulations that make certain forms of savings impractical or illegal to hold. In 1933, it was gold. In 1998, it was rubles. In 2013, it was Cypriot bank deposits. In 2022, it was frozen Canadian accounts. Each case had different specifics, different legal justifications, different outcomes. But the underlying mechanism, using state power to access private wealth during crisis, remains a persistent feature of financial history. And here's the pattern that history repeats in every language, every century, every crisis. The system protects itself first, not you, not your savings, not your property rights. When pressure mounts and options narrow, extraordinary measures follow, always justified by necessity, always framed as temporary, always imposed on those least able to resist. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.